Welcome, Model FAs. David DeCelle here, CEO of Model FA and your host of the Model FA podcast. And we are joined here today by Scott Leak with FP Transitions. And he is both a CFP and CEPA designated. And for those of you who may be unfamiliar with the CEPA designation, it stands for Certified Exit Planning Advisor. Which is a great way to set the stage for today's conversation, because what this podcast is going to be about, beyond Scott's background and a little bit about FP Transitions, is for those of you who are building a business to ultimately exit, making sure that you're getting fairly compensated for all the blood, sweat, and tears, time, and dollars that you've put into your business. We're going to be talking about that today. And this will be relevant to you whether you're actively looking to sell your business, or if this is something that's 10, 15, 20 plus years down the road. We're going to be talking about some things that you can do now to make sure that you get the best bang for your buck, so to speak. But with that said, Scott, welcome to the show.
Thanks so much. Appreciate you having me here.
Of course, and you're gonna be in my neck of the woods in about a week of this recording, anyways. In Florida, you going down for business or personal stuff?
Yeah, I'm speaking at RA Edge next week.
Very nice. I haven't been to RIA Edge before. What's the typical attendance at that
Uh, I
conference?
I actually haven't been yet either. I think we've got 1,100 people registered for it, so pretty good sized conference this year.
Very nice.
Yeah.
Awesome. Well, let's get rocking. So, I'm sure you didn't, get out of school and start working with FP Transitions. There were probably some steps in between. Give us a sense of your background.
There weren't many steps in between. I went straight from school to a company. Gosh, and I hate to say it, but the year began with a one. I started with a company called Ameritrade, which became TD Ameritrade, which became Schwab. So I spent 22 years at TD Ameritrade, almost the entire time on the RA custody side. So I did a lot of work in sales, relationship management, practice management, consulting. I actually calculated at one point in time, I've physically been in over 1,000 advisor offices in 43 states.
Wow.
Yeah. So I had a really, really enjoyable time at TD. And when the Schwab acquisition came along, I was the Midwest Sales and Relationship Management Director, and I kind of raised my hand and said, "You guys already have one of those. I'm happy to go do something new." And so they were kind enough to let me go and give me a nice little severance for my 22 years of service. And I had a number of different things I was considering. Like you mentioned, I've got my CFP designation. I thought maybe I'll go be an advisor. I called a lot of the advisors that I know, particularly here in the Midwest. I'm based in Omaha, where TD was headquartered, and talked to a lot of advisors that I got to be kind of friends with and considered really smart people. And some of them said, "Yeah, you'd probably be a really good advisor, but you might be bored after a while if you're not doing anything strategic like you're used to doing in your current role." And I had a couple said, "Why don't you come work for us and run business development for us?" But I talked to one advisor in particular, Richard Brown, and Richard gave me some really great advice. And he said, Scott, you could go work at an RIA and make a big difference at that firm, or you could go do what your other option is, which is work at FP Transitions and affect the industry. And so that really was a pivotal piece of advice for me. So I had a friend that worked at FP that I worked with many years ago, and I went out to Lake Oswego, just outside of Portland, Oregon, and met with the CEO and some of the other leaders in the organization, and walked away really impressed and said, "This is a place where I can do a lot of the things that I liked about TD." TD was a great place for advisors. Like, we had no minimums there. Like, anyone could use TD as Ameritrade as a custodian, and we just tried hard, and all the things I loved about the TD culture, I felt at FP Transitions as well. And I really love how, and we'll probably talk about this a little bit today, we really look at ourselves as stewards of the industry, of the independent wealth management industry, that, we're actively trying to go out and, do things like this, where I can be evangelical about everyone needs to have a continuity plan. get something in place for your clients, for your staff, for your estate that says, hey, if I get hit by the bus tomorrow, everyone's going to be taken care of. So just things like that. And then trying to make this industry enduring and sustainable. I think one of the biggest advantages that wirehouses still have today over the independent channel is you go hire an advisor at Merrill Lynch, you've got an advisor for life. It might not be the one that you hired day one, but you don't have to worry about ever shopping for another advisor again. And certain independent shops that are maybe a little bit smaller that don't have a succession plan in place, that's not necessarily the case. And like how awful it might be for a client when you probably need your advisor the most, that they're like, all right, I'm retiring, closing the business, see you later, go find a new advisor. So I'm very passionate about trying to address this issue for the industry and kind of close that one final gap we have in what makes the independent space better than the wirehouses.
Love it. Now, walk me through what is your current role at FP Transitions?
So I started off as one of our senior consultants. So we've got a membership service where advisors will pay us a monthly fee. We do a valuation for them. We do a continuity plan for them, give them benchmarking, and then give them coaching to the data we find in the benchmarking. So we might find something that we can help pinpoint. How do you increase the value of the business if you're looking to become a seller 5, 10 years from now, either internally or externally? How do you maximize the value of the business? What things can you do now to position it for ultimate sale to somebody? So I did a lot of that consulting work and then got my arm twisted to get back into management. So I now run business development for the company as well. But I
Understood.
still really enjoy the consulting work, and I do that from time to time as well.
Cool. And for those who, and I say this tongue in cheek, but for those who may be living under a rock and haven't heard of FP Transitions, um, give us a quick overview as to what you guys actually
Yeah.
do and the scope of
So
work that you have the capabilities of.
Yeah, FP Transitions started in 1999, so over 25-year-old company now. We, to my knowledge, we do more M&A transactions than anyone else, more than any other broker or investment banking firm. We did 100 M&A deals last year. We'll do that again this year. We do over 1,000 valuations of advisor practices every year. So one of the things I love, like what enables us to do our benchmarking so well, is we've got a database of over 17,000 valuations now, each one containing over 100 data points about advisory revenues, expenses, client demographics, et cetera. So we've got incredibly robust valuation and benchmarking capabilities. And then we do a lot of work on just kind of project-based consulting. So we might look at a firm who's made it to 500 million, wants to get to a billion or 2 billion, and they'll say, hey, I don't think what got us here is going to get us there. I'm a little concerned that, at some point in time, if I keep going the rate I'm going, I'm going to have advisors working for me that make more money than I do as the owner. So we'll look at entity structure, org structure, comp structure, and potentially redesign those, retrofit them to maybe the way they should have been built in the first place. But most of these businesses weren't designed to become these huge enterprises. They just started off as somebody who was really good at money management or financial planning and just didn't want to work for the man anymore. And they never really thought they'd turn into these enterprises. And so halfway along the way, they might come to us and say, all right, now that I know that this can really turn into something, help me do it the right way. So we do all kinds of work on those things, talent optimization, getting them ready for doing inorganic growth, preparing them for M&A, either on the buy side or the sell side. And a lot of times people will come to us too, where, they just buyer and seller found each other and they're like, hey, can we leverage the fact that FP Transitions, which has 65 employees or so, 10 of which are attorneys and paralegals. Can we just leverage your expertise to help us come to deal terms, draft all the necessary documents and contracts to solidify our M&A transaction? So um, anything kind of related to continuity, succession, M&A, valuation, and entity and enterprise strength is our core focus.
It's interesting where you say, a lot of times people get into the industry because they're good at money management or financial planning, and never really had, excuse me, their sights set on having an enterprise level firm. And I come across a lot of folks like that where there's this inflection point where they're like, crap, I actually have a pretty legit business.
I'm a
But
business owner.
right. And they oftentimes, don't have the systems and processes or compensation structures
Yep.
to be able to extract the true value out of that company, and ultimately, if they stayed on that track, would be selling at a discount compared to
Yep.
what they could get. um, what are you seeing in the industry, ranging from like the $50 million firm to the $5 billion firm in terms of a range of multiples, just to help set the stage? And are you finding that the industry is more of a multiple on revenue, a multiple on EBITDA? Like, help us understand what the current landscape looks like.
Well, interesting that when we do our valuations, we don't actually state a multiple. We state a exact dollar amount. So because we do so many transactions, we've got so much data that we can say this is what the average deal was last year. We can tell you, you know, if this is the value, it's assuming most probable selling price under quote unquote average deal terms. And average deal terms vary, but the average last year was around 40 to 50% down payment, the rest on a note. That note was anywhere from 2 to 5 years. But then there's certain assumptions of what's the tax treatment of it, how much of it is going to be allocated to long-term capital gains versus ordinary income. All of those things affect the actual ultimate price. So depending upon what the seller's goals are, might affect what the ultimate multiple is when it comes time for the transaction to occur. And sometimes people are willing to accept a lower multiple or a lower dollar amount in exchange for other things they really want. And so some of those things could be, a higher down payment. I'm willing to accept, less cash because the buyer takes on more risk with more guaranteed money up front. Meanwhile, maybe the price goes up if they take a longer, payout structure where there's more risk on the seller to do that. So it really kind of depends. And I'm kind of dodging your question because I hate giving the actual number amounts because everybody will just stick to it. And I'll give you a dollar amount, but or some multiples. But I want to illustrate something real quick. Let's say you've got a practice that has 1 million in revenue, okay? Mostly recurring revenue, let's call it an RAA. And if you just use the rule of thumb that I give you here, you could be off by a very considerable amount. So let's just say you're going to go, all right, 3 times revenue multiple. That puts the value of the business at $3 million, right? Well, what if the multiple is actually 2.9? You've made a $100,000 error by being off by zero point 0.1 on your multiple. So pay us $1,500 to do an actual true valuation and get an idea of what the real amount is. The ranges on a revenue side for a practice that maybe is around 80% recurring revenue or more, you're probably looking on the low end of 2.5 times revenue. For a firm that's getting a little bit larger, mostly recurring revenue, has a succession plan in place, is growing at a good clip, has really impressive client demographics, that can fetch well north of 3 times, maybe in the 3.25. As you start to get to enterprises, though, you're looking at multiples that are going to be more based on EBITDA rather than revenue. Like that's how you're going to see a deal structured from like one of the large aggregators. They're going to state it in EBITDA multiples, but EBITDA multiples can also be, or EBITDA itself can actually be pretty easily manipulated. And so that's where you're going to see really wide variance and why you're going to see companies that are going to say, all right, well, we need to actually recast EBITDA for us to come up with a more accurate assessment. So there can be kind of disagreement as to what the EBITDA multiple is because there might be disagreement on what actual EBITDA is.
Understood. Now, whether you gave sort of categorically some differences between some firms just a moment ago. I'm curious to know more specifics on the characteristics of different firms that affect the multiple. Like, why is someone getting 2.5 compared to 3.25x
Mhm.
on revenue if both their revenues $1 million? You mentioned something to the effect of strong client demographics. Like, what does that actually mean? Like, if we can go a layer deeper
Sure.
to get a good understanding as to how that range that you shared is
Right.
actually decided upon.
So let's take a moment and think about like what's actually happening here with this transaction. You're buying a privately held company. the assessment you do to determine to buy a privately held company shouldn't be much different than your assessment to buy a publicly held company. So think about like if you're just going to go and pick a stock that you're going to buy in your portfolio, then your choices are, you know, Ford or Tesla. Now, you're going to view them in different lights because one's been around a really long time, one's fairly new, one might be growing at a faster rate than the other one might have more long-term future upside. Past performance is not indicative of future
Hmm.
performance. So you're going to look at an RIA that you're looking to purchase from that same lens of, well, which one is stagnant and which one's growing? So if you're going to pick between buying a stock that's stagnant or buying one that's actively growing, you're probably going to pay a little bit more for the one that's growing well. And then if you look at the client demographics, think about it just logically. If you're going to buy someone's practice and the revenue stream is coming from the end clients, and you've got a bunch of 80-year-old clients that are each worth $1 million versus another firm of the exact same value, same number of clients, but they're all Silicon Valley 30-year-olds that are also worth $1 million. Which one would you rather pay more for? So those are the types of things that we factor in when doing evaluation. It's not just how much revenue is it. It's the quality of the revenue, the quality of the revenue stream, and the likelihood of that revenue stream to increase down the road. You're willing to pay more for it and take a couple of years to break even if it's going to be growing fast and going to last a long time.
It's interesting. I have a client, Alex, who's um, in conversations with an older advisor in his, I think, 70s. It's a smaller book of business, and he was talking about how he's interested in acquiring that, which, side note, probably a good introduction for you guys. So hold me to that after we're done recording. But
All right.
um, uh, this advisor's practice, who he's looking to purchase, all the clients are in their 70s and 80s. And he had talked about like the industry standard of, 3x, the revenue. And I was like, well, you could probably get a deal because you have an asset that, based on its current state, is a decreasing asset.
Yeah.
They're distributing, and if this advisor, which he doesn't have relationships with the next of kin, those assets likely are going to go out the door, which is in turn going to require you to work harder and more diligently to get in front of the next generation to make sure that that asset that you bought is actually sticky ultimately when they do, pass away. So you could probably get a pretty good deal on that. So with that said, like, let's say I'm an advisor, I'm, you know, I don't know, in my 40s or 50s, and I still have 10, 15, 20 years of run room. I guess a two-part question. One is, what are some things that I can do to my business today to ensure that the value is the highest as possible when I do go to exit? And then number two, in that scenario, if I don't want to sell and retire, but I just want to take some chips off the table, what are you seeing in the marketplace currently?
Okay. So really good questions. And the first one is a huge part of what we do. It's why we've got, over 1,000 advisors that just have us on retainer because they want to value the business every year, benchmark it, and know what levers do I need to pull to make it better. So we've got about 50 different key performance indicators that we measure in the benchmarking. And so, what I would do when I was doing the consulting day to day, I'd review someone's, annual benchmarking report with them and I'd pinpoint, all right, let's not worry about all 50 KPIs. That's overwhelming. But let's maybe pinpoint four that I've identified that really are going to move the needle the most. And so what the objective is going to affect which KPIs we want to focus on, and each firm's a little bit different. So someone who's maybe coming to me who wants to benchmark because they want to be on the buy side, I might focus more on KPIs related to how do I increase scale and capacity for you to be able to absorb another practice. And I would be totally fine with you dipping down and having a lower margin on the business, lower profit margins for the sake of building that scale and capacity. For someone who's going to be on the sell side, I might put more priority on that profit margin and getting that as high as we can. Again, kind of getting that EBITDA to be as high as we can to get the highest multiple out of that. So I might focus on that. And, what is our average client size? Can we get that a little bit larger? So it just kind of depends on what the data tells me that helps us get an indication of what are the insights we can learn from the data to inform action on each individual situation to improve that. But profit margin is going to be huge, growth rate is going to be huge, and then the client, the book itself, can you maybe pair off some of those C and D clients in some way, shape, or form and boost the average account size? I've seen firms that'll come to us just to do a partial sale of those clients that can actually, even though AUM might drop and revenue might drop, could still cause an increase in value.
Interesting. I have some more questions on that, but I do want to get your insight on my second question around folks who are just looking to take some chips off the table, but still grow and be a part of the firm, maybe even maintain their own brand as opposed to assuming a new brand in that transaction. What are you
That's
seeing
70, that's
in that?
70% of our sellers.
Okay, so talk to me about what you're seeing in the marketplace currently with that.
Yeah, the days of kind of sell and walk away are almost over. I mean, that was the most common type of transaction when this company started, and it's totally shifted to more of that model of what we originally called sell and stay, and I don't even like calling it that anymore. It's finding a partnership. So for a lot of these advisors that want to grow, want to take some chips off the table, the best thing to do is to find out in the marketplace, either using a company like FP or, responding to a lot of the calls and letters that you're probably getting unsolicited from, firms wanting to do acquisitions. But what we do is help kind of quiet that noise, compare apples to apples, do a wider search, find that perfect fit, take some of those chips off the table, and that can have a lot of amazing benefits. So number one, a lot of these firms, we kind of talked about, we haven't used the term yet, but they kind of become accidental business owners, right? They never intended to build these practices that got to be as big as they did. And now you might reach a point as the owner where 50% of your time is not even in a client facing role anymore. Maybe you want to get back to doing that because now you're doing a lot of this BS of, managing people and making tech decisions and hiring compliance and all these things that are distracting you from actually growing and, maintaining the clients. So by taking the opportunity to find a partner out there that'll take that stuff off your plate, take some chips off the table, because this is most likely your largest asset, and you would probably advise a client to diversify your net worth.
Hmm.
And so this is an opportunity to do that. Get some cash, which you can use in any way, shape, or form. You can go out and buy the S&P, or you can reinvest in the business, but take some chips off the table. And a lot of times what happens is they're also getting this really cool thing that we're seeing a lot more now of a tax deferred equity exchange in your business for the business that you're partnering with. And what's going to happen is you're maybe trading at, let's say, 6 or 7 times EBITDA, and you're partnering with a firm that's already trading at 10, 12 times EBITDA. You do this tax deferred swap of equity from your company to theirs. Maybe you get some cash too, but you do this swap for equity, and then you hold on to that for the next 5, 10 years until you're ready to truly retire. You then get a second bite of the apple. You get to sell those shares down the road, and you're going to sell them in a company that was growing faster than yours, that has more capability than yours, and is trading at a higher multiple. And by the time you go to sell it, it's probably even at another higher multiple. Maybe it's at 15 times EBIT at that point in time. And you would have never gotten to 15 on your own. So that second bite of the apple, oftentimes, plus that first effort to take chips off the table, is more lucrative than if you held onto the business and sold it 10 years later.
Yeah, I
And
see
you probably
that.
made your job easier and were able to grow faster as well because you got more resources.
Yeah, I see a lot of the times, and I'm just speaking in a general sense, but a lot of times they'll get like half the cash up
Yep.
front, and then there's the other half is the equity swap, and it's
Yep.
just it's arbitrage and, like you said, linking up to an asset that's growing faster than you, that has more resources than you, that you're
Mhm.
benefiting from all the activities that they're doing, all the other people that they're scooping up like you,
Yep.
and you get to not just get another bite of the apple, but you get a bite of a much larger apple, because of all the acquisitions that they're doing as well.
Absolutely.
Pretty sweet. So as far as like, I'm curious. So one of the exercises that we bring folks through is an energy audit. And basically, it's sort of a play on Stephen Covey's time management quadrant, where
Right.
it's like from an energy standpoint, things that you love to do and you're great at, things that you like to do and you're good at, things that you don't like to do but you're still good at, and things that you don't like to do and you're bad at. And when you had made mention, I thought of this when you had made mention about oftentimes they're spending 50% of the time not in front of clients doing stuff that they don't want to do. And oftentimes they're stuck in those bottom two quadrants. So, do you guys bring folks through a similar exercise for the purposes of awareness, right? First step is admitting that there's a problem.
Mhm.
And then as a sort of like a matchmaking mechanism of, hey, these firms over here can totally remove these two quadrants, bottom quadrants, from your day to day because that's their value prop. Do you bring them through a similar exercise?
We do. It's not as well structured as that. I really like that approach. It kind of reminds me of the Eisenhower box of urgent, important, not
Hmm.
urgent, not yeah. So what we do, it's a little bit like creating an eHarmony profile. So we'll sit down with someone who makes the decision like, all right, I know I want to find another partner to help me, and sometimes I might have somebody that's like in their 40s that decides to do this. And knows that I'm going to grow faster with these resources, the other organization. But oftentimes it's someone maybe in their 50s or 60s that's just thinking like, I really want to enjoy the fourth quarter of my career, and I'm going to enjoy it more if I get these things off my plate. And so we just sit down and talk with them, and we do a lot of just kind of consulting on the front end. When someone signs an engagement agreement with us to have us find them that perfect partner, do all the negotiating, do all the paperwork, get their deal completely finalized, it's a good 6 month process for it. And the first month is just getting to know them and figuring out what are their nice to haves, what are their must haves, what are their deal breakers. And we create a seller profile the way you would kind of create your profile on eHarmony. And then we ask everyone who's interested in acquiring that practice when we put it out on the open market, all the people on the buy side need to do the same thing. And then they actually have to write an essay to the seller of why are we going to be a good fit? Why should we talk? And so on average, we kind of have a two-pronged approach to our M&A search. We do an active search and a passive search. So the passive search, and this is why we're able to do more deals than anyone else, is that we've built the technology to do that, put it out on the website, blast it out. We have 30,000 people that are now signed up to get alerts from us when we've got a practice for sale. On average, about 80 inquire on each practice, depending on location, fit, et cetera. We'll do the quantitative analysis, making sure buyer profile and seller profile fit of what are the strengths, what do they want. So, for example, the seller might say, I'm not going to partner with a firm that doesn't have a CFP on staff. Well, we look at the buyer profile and make sure they check the box. We've got a CFP on staff. And so we'll do that quantitative analysis. Then we read through all those essays and we do the qualitative analysis at that point. And we might narrow it down to, let's say, 8. So of the 80 that inquired, we might go, all right, seller, you've got 8 firms that met all your criteria. Why don't you look through these profiles? You can read all 80 if you want, knock yourself out. But part of what you brought us in to do is to avoid that deal fatigue. So review the 8, and they might come back to us and say, hey, these 5 are really interesting. So then what we do is we reach out to those 5 and say, sign this NDA. We set up a call between seller and buyer. We're on every single call with that seller and every single suitor until we get to a point where we might say, all right, we've narrowed it down to 3. We'll tell those 3, hey, submit a letter of intent. We help the seller kind of review each letter of intent to figure out, all right, who's hit everything just right. And it might be that one firm is the front runner in terms of fit. And that is our top objective. Make sure we get the right fit. So we'll say, all right, this one's got the best fit, but maybe it's the second best offer on the table. And we'll go back to the buyer and say, you're their top choice, but you're not the best offer. Can you sharpen your pencil? Can you make it look more like this? And it may be that the buyer just didn't quite understand what the seller really wanted. Maybe they wanted more down, maybe they wanted more equity. So we just kind of coached them like, this is what they're really looking for. So we get to the point where it's like, all right, LOI is accepted, continue doing due diligence, and then we draft up all the contracts and things get signed when that match is made. But yeah, it starts with a good couple weeks to a month of us just getting to know what does that perfect fit look like for them.
What do you see currently and moving forward? So the M&A space has been hot for a while. A lot of private equity has come into the industry. Are you anticipating it to cool off at all? Has it cooled off at all? Or is it pretty, you know, is it pretty consistent both now and in the future to what it has been so far?
So since the start of the second quarter, so I'm giving you really, really recent data here. Since the start of the second quarter, we've been averaging one call per day of someone saying, I want to find a partner per day. It's that it was not like that even last year. I don't know if it's people are just the tariffs and just clients being a little freaked out by the economic uncertainty, and some advisors are just like, I don't want to deal with this anymore, or I want help dealing with this. So I don't know if it's that or just yeah, people are saying these multiples are too good to pass up, or I want to take some chips off the table, or I want a capital infusion to grow because a lot of these partner firms that's what they're really getting is that they're getting the resources to grow faster than they're growing today. And a lot of the offers that they see, there's the core component of the offer, which is just the down payment, the note, all that. But that's usually just a third of the deal. There's the compensation component, and then there's the growth incentive component. So the deals are getting more sophisticated to be more complex, and they're getting harder to compare apples to oranges, which is why people are calling us for that type of help. But what we're seeing is the market is still very, very frothy, and I don't see it slowing down anytime soon because most of the firms that are on the buy side, they're not just looking for the revenue and the clients, they want the talent that's coming with. And the talent is getting very, very hard to find, particularly if you want experienced talent. So that's part of the reason why the valuations are staying as high as they are. I think people want to say it's like, oh, it's because of the PE money. That's a factor to a degree, but PE money is not involved in most M&A transactions. So what's really driving it in my mind is that every day people are realizing this is really worth what these valuations are because the client revenue is so sticky, it's so recurring. The average client stays with their advisor for more than a decade, and the ROI is going to be much shorter than that when you're buying something for three times revenue. But then it's that talent grab, and it's the advisor who's actually quote unquote selling, who wants to keep working for 5 to 10 years, and then they hopefully have some G2s on staff, and if they do, and those G2s have an equity stake as well, they drive the multiple up even higher.
Do you see many deals not going to a buyer or private equity, but rather transacting through an ESOP, or are those more rare?
ESOPs are pretty rare, and I'll give you a couple of good reasons for it. Number one, if you're under 25 million in revenue, it's really expensive. I mean, you're talking at least 50 grand just to set it up, and probably that same amount to maintain it every year. The other thing that scares a lot of advisors off, you now have another regulator in your business. That is under ERISA. The Department of Labor is now one of your regulators too. That's usually enough for making them go, I don't want to do an ESOP. Now, the
Gotcha.
nice thing is there's all kinds of other solutions. Like we help firms do both real equity and synthetic equity. So maybe there's something you want to do where you're giving everyone in the company who's maybe not necessarily fit to be a partner in the ownership circle, if you will, but they get all the upside of the growth of the company through some form of synthetic equity, whether it be phantom stock or stock appreciation rights or profits interest or whatever it may be. So we sometimes will structure synthetic equity for people that don't have the will, skill, or the risk appetite, or want the responsibility of ownership. Maybe like there's an ops manager that you want to put the golden handcuffs on them and give them that upside, but they're not truly fit to be a partner.
Gotcha. Um, Before we start to wrap up, I want to know what you've seen as far as like deal killers. So like what like absolutely ends up squashing a deal that you've seen. Like so you're at the 5 yard line and then, you know, it burns up in flames. What are some causes of that?
I hate to be cliche about it, but I'm going to use the old saying, time kills all deals. So the longer you stretch it out, whether it's you or your attorneys that are stretching it out, because a lot of attorneys like to charge by the hour. And so the longer the deal takes, the better it is for them, which is why we do not charge by the hour. So yeah, the longer the deal takes, the more likely it is to fall apart. Um, and I think just not doing enough proper due diligence on the front end to make sure it's a good fit. I think a lot of times the cold feet happens when there's that realization that I tried to put a square peg in a round hole. I got excited about seeing the multiple. I got excited about the opportunity. And I maybe did respond to that person who just sent me an unsolicited email that was an aggregator that, had a great offer and it looked really enticing, but you didn't do enough due diligence to look out there in the open market and go, did I find the absolute best perfect fit for my clients? And maybe in the last minute you realize I was maybe just a little, if you're being honest, you maybe got a little greedy and didn't do your due diligence on, was this the absolute best fit? And that's the thing I try to tell people, our passive approach as well as our active approach of calling. And like we work with so many different buyers every year, locally, regionally, nationally. We do that proactive outreach. We do the passive work on our website to find matches. What we're really trying to do is get that perfect fit. So we want advisors to be able to look their client in the eye when this transaction's done and go, I left no stone unturned finding the best fit for all of us.
And you guys are 65-ish people strong. That's a
Yep.
legit squad to handle all the business that you guys are taking in. That's wonderful.
Yeah, so we've got certified valuation analysts to work on the valuations team. I got CFAs working on our financial analytics team. They're the ones that do like cash flow modeling. And when we're doing a succession plan, we'll want to map out what does the next 10 years of this succession plan look like? How does this financially work for G1, G2? Again, got 10 attorneys and paralegals on staff. You got people like me with the CFP and CEPA designation. I've got former RIA owners on staff. I got MBAs on staff, CPAs on staff. So we've got a lot of expertise, and we try to be that truly holistic turnkey solution that you don't really need to outsource anything other than if you need bank financing, that'd be the only thing we won't really do.
Badass. So before we wrap up, one of the questions that I ask all of our guests is a book that's had an impact on them. And I've been waiting for this segment of the show because your response wasn't a book, but instead you filled out anything not written by Dickens. Tell me what prompted you to put that in there.
So I've got three teenage daughters, and so I do a lot. I try to kind of read with them. So I'm reading my second Willa Cather book of the year right now. But when we got to my daughter reading A Tale of Two Cities, I'm like, I am not reading Dickens again. The guy got paid by the word. I'm not. I can't do it. My youngest daughter's name is Harper, so my honest answer might be To Kill a Mockingbird. I named my daughter after Harper Lee. So I do love that book on the fiction side. On the nonfiction side, I was really my extra undergraduate degree is in psychology, so I loved The Road Less Traveled by M. Scott Peck.
Hmm.
So that's a kind of a favorite, one of the first, if not the first, kind of self-help book. Um, so those would be my legit answers. But no, I cannot stand reading Charles Dickens. I told my daughters, I'm like, I'm not reading along with you on this one. I just can't do it.
So you weren't expecting this question, but you said something that opens the door. So September 1st, my wife is due with our first child,
Congrats.
and it's a baby girl. What advice do you have as a girl dad to a future girl dad?
Whew, yeah, and all I got is three girls. So, yeah, I mean, if you don't have a shovel and a shotgun, those are good investments. Uh,
It's funny when I told my pastor that we were pregnant and it's a girl. He's like, "Congratulations, buy another gun."
yeah. Um, no, I try not to really treat them any differently because they're a girl. My girls are all swimmers. They're all left-handed, which I'm not. Their mom is, but they're all incredibly artistic. One of them knew in eighth grade she wants to go to the University of Iowa because it's the number one creative writing program in the country. And I'm just being as supportive as I can of that, even though in the back of my mind, I'm like, God, I hope you can make some money. But, support whatever they want to do. my girls all know how to throw a football and hit a baseball, but they're all incredibly good at painting or sewing or whatever it is that right brains of theirs are capable of doing. So yeah, love them. Tell them they're safe and that they're loved by their dad and they're able to talk to you about anything they want to talk to you about. And that's as far as I've gotten at this point with three teenagers.
Well, I appreciate that. I'll keep you posted on how I do. I gotta rise to the occasion and figure it out. But for those advisors which this has been a very concise and jam-packed episode with some value. So if I'm an advisor and I haven't reached out to you yet, where's the best place for me to go?
You can go to FP Transitions, FP as in financial planning, fptransitions.com. Pretty much any page on the site, there's a button to click schedule a consultation. I've got a really great team of people that know what they're doing. The veteran on my team has been with the company 13 years. So we've got some really great people that know this industry inside and out, know what we do inside and out. So anyone on my team, click on that link, schedule time to meet with them. We'll give anyone, whatever time they need to just kind of diagnose what it is that they want to get done. If anyone wants to reach out to me directly, LinkedIn might be the best choice. I'm just, Scott Leak, Leak. So if you go to LinkedIn/Scott Leak, you can find me there. And if anyone's I guess this is air after I'm at RA Edge, but I tend to go to a lot of conferences. I'll speak at a number of them this year. So if you ever see me at a conference, grab me and say, "Hey, I heard you on David's podcast. Let's talk." So happy to
Awesome.
help any one of your audience members.
Cool. Well, Scott, I appreciate your time today and for everyone tuning in. I appreciate your time and attention, and we'll catch you on the next episode. Have a good day, Scott.
Thanks, David.